Have you ever considered the intricate journey your food takes long before it reaches your plate? From vast ranches to bustling markets, the path is more complex than you might imagine. This journey often involves a sophisticated trading system that directly impacts the cost and availability of everyday items. When we talk about livestock as traded commodities, we are primarily referring to live cattle and lean hogs. These two categories representing a significant portion of the global meat supply and are actively bought and sold on futures exchanges, making them key benchmarks in the agricultural commodity sector. The reason these specific types of livestock become traded commodities boils down to a few fundamental characteristics. First, they are highly standardized. Live cattle, for example, are traded based on weight and quality grades, ensuring that one contract is essentially interchangeable with another. This concept, known as fungibility, is crucial for any commodity. Second, there is consistent and massive global demand for beef and pork products, creating a large, liquid market. This steady demand, coupled with the seasonal nature of raising livestock, creates price volatility that producers and consumers need to manage. Futures contracts provide a vital tool for farmers to lock in future selling prices and for meat processors to secure future supply costs, thereby reducing financial risk for both parties. This process also contributes to transparent price discovery, where the market openly determines the value based on supply and demand. Participating in the livestock commodity market primarily happens through futures contracts, most notably on exchanges like the Chicago Mercantile Exchange or CME Group. An investor or market participant does not typically take physical delivery of a herd of cattle or a group of hogs. Instead, they trade contracts that representing a commitment to buy or sell a standardized quantity of these animals at a predetermined price on a future date. These contracts are essential tools for hedging against price fluctuations and for allowing market participants to speculate on future price movements, without the logistical challenges of owning live animals. Consider the specifics. A standard CME Group live cattle futures contract represents 40,000 pounds of live beef cattle, while a lean hog futures contract represents 40,000 pounds of lean hogs. These precise specifications ensure market clarity and liquidity. Another important but less actively traded livestock commodity is feeder cattle. These are younger, lighter cattle that are purchased by feedlots to be raised to market weight. The trading of these specific standardized units allows for efficient risk management and price setting across the entire meat production supply chain. Understanding which livestock are traded commodities offers a fascinating look into the global food system. It highlights how financial markets play a critical role in stabilizing agricultural production, managing risk for farmers and businesses, and ultimately influencing the prices we see at the grocery store. By knowing the underlying mechanisms of these commodity markets, you gain valuable insight into the interconnectedness of our economy and the dynamic forces that shape the availability and cost of essential food products.